Usually railroad earnings are about as exciting as watching paint dry, but Union Pacific is somehow pulling off record train speeds while dealing with falling volumes and fighting the federal government over the biggest rail merger in history. Welcome to Earnings Unscripted. It is April 23rd, 2026, and today we are tearing into UNP's first quarter.
Right, and it is not just a narrative, it is showing up in the underlying operations. Because if you look at the raw numbers, overall freight volume actually slipped 1%. But they still managed to easily beat expectations. Adjusted EPS came in at $2.93, which is up 9% year over year. It's actually really impressive when you consider they are dragging the weight of a stalled, massive acquisition.
Yeah, definitely. Oh, and before we go too far down the track, sorry, I couldn't resist, just a quick reminder that everything we talk about here is just our personal opinion and absolutely not financial advice, so do your own homework. Anyway, the top line revenue hit $6.21 billion, up about 3%. But what really caught my eye is the stock reaction, because traders loved this.
The tape was wild. The stock had a fairly choppy quarter leading up to this, drawing down hard in late March to close around $239. But this morning, the second that earnings call started at $8.50, the stock basically went vertical.
Wait, it gapped up to, what, 262 at the open?
Up to 262, yeah. And
Wow.
It just kept grinding steadily higher all session, closed up over 7% near 267. The market is looking at their operating margin hitting 39.5%, and they are buying the efficiency story. Because, last quarter we were pretty skeptical when their earnings beat was mostly propped up by a one-time land sale.
Right, the industrial park thing.
Yes, but this time the operating income actually grew 4% organically to $2.46 billion. They did that by making their freight cars move 9% faster and aggressively shrinking terminal wait time. So they're running a significantly tighter network.
They definitely are. But it's not perfectly smooth across the board. I mean, they're still taking some hits on the consumer side. Premium freight revenue dropped 5%, and volume for things like vehicles and international shipping plunged 9%. So they're clearly leaning heavily on core pricing power to make the overall math work.
They are. Core pricing offset the volume loss completely. The actual problem is whether this new efficiency can absorb what's coming next month. They just ate $36 million in merger consulting fees for the Norfolk Southern deal, and their fuel estimates are suddenly entirely obsolete because diesel just spiked over $4 a gallon.
Okay, yeah, that fuel surcharge lag is going to be incredibly painful in Q2. All right, let's get into the details.
The fuel lag is a mathematical certainty, yes. They will absolutely take a hit there in Q2. But what I find much more interesting, or actually much more revealing, is how they are physically running the yard right now to insulate themselves from that exact volatility.
You mean the dwell times dropping? Because we briefly mentioned terminal wait times went down 11%.
Exactly, 19.7 hours. But the mechanics of how they did that are fascinating. Everyone talks about artificial intelligence as this mystical, futuristic thing, but Union Pacific is using it to do the most boring, highly profitable work imaginable.
Which is usually the best kind of work.
It really is. They rolled out this terminal command center, basically an automated movement planner. In the old days, if a human operator sorted a train wrong, like they accidentally swapped the wrong rail car in a multi-car cut.
Like sliding a puzzle piece into the wrong spot on a moving board.
Precisely. And it would take hours to unscramble, which just backs up the entire yard. But now their AI is auditing those sorting queues in real time. It catches human mistakes 2 hours before the physical car even hits the switch line.
Oh, wow. So they are basically correcting history before it happens.
Something like that, yeah. And Eric, their executive vice president of operations, had this perfectly dry quote. He said, "We are not in the business of hobbies here. We are in the business of delivering value."
That is such a grounded operational guy thing to say.
No science projects, just stripping out friction. And Jim Vena gave this great example of how dynamic the network is now. Apparently, the morning of the earnings call, a massive snowstorm buried the Donner Pass in the Sierra Nevada, completely freezing the route while the rest of the map was sweltering in the heat.
Right, the heat waves happening down south.
Yes, and previously, Vena said it would take weeks to manually redirect resources away from a blockade like that. Now their predictive models adjust the traffic in days. They are parking hundreds of unneeded locomotives to serve as dynamic buffers.
Park them? That sounds, I don't know, wildly expensive, just having massive capital assets sitting dead on a siding somewhere.
It is expensive if you measure it wrong. But if parking them keeps average train velocity up at 235 miles a day, you drive down equipment rent costs, which they did by 9% year over year.
Okay, that makes sense. You keep the overall flow moving instead of optimizing for individual pieces of metal. But there is a massive friction point here, Miro. If they are this efficient and they need 5% fewer workers today, how does that square with Vena promising the unions an ironclad job guarantee for the Norfolk Southern merger?
Yes, the merger politics.
Because he specifically said, we've guaranteed a job for everyone. That kind of ironclad commitment sounds like a massive anchor around the neck of all this AI efficiency.
Well, it is and it isn't. Vena is betting that normal historical attrition, basically people retiring or quitting naturally, will be enough to balance the ledger. He is aggressively buying labor peace because he desperately needs this merger approved by the Surface Transportation Board.
Which got totally derailed in January. The STB completely discarded their joint application for being incomplete.
They rejected it without prejudice, yes. It was a warning shot, so Union Pacific is refiling on April 30th, and they are hedging their approval expectations out to the second quarter of 2027, and they are doing whatever it takes to secure it.
Completely. I mean, totally freezing capital returns because the stock buybacks are just gone. They had a 100 million share authorization running through 2028, and they simply turned the tap off.
Zero buybacks. They are hoarding every dollar of capital to preserve their debt metrics for the $20 billion cash portion of the buyout. It is an empire-building bet. They are trading immediate shareholder yield to redraw the map of North American infrastructure.
The scale of this is just crazy. But how does he justify the monopoly argument to the regulators? If you merge and create America's first transcontinental railroad, the government is going to scream antitrust.
Vena's defense is almost comical, but also kind of bulletproof. He basically told them, look, we are not competing against a regional firm. We are competing against BNSF. And BNSF is owned by Berkshire Hathaway, which just crossed a $1 trillion market cap.
Right. He pointed out Berkshire has over $300 billion in cash.
Exactly. He is essentially telling Washington, you have to let us become a monopoly so we can survive a fight with the other monopoly.
That is such an incredibly bold spin. I kind of love it. And didn't he also throw Canada under the bus?
Oh, entirely. He complained about state-sponsored port expansions up in Prince Rupert, and he threw massive shade at Canadian Pacific. He said, I would be more than willing to trade Toronto for access to Denver if somebody wants it tomorrow.
Wow. Shots fired at the hometown. But you know, setting the drama aside, it really paints a distinct picture. They are stripping the operational engine down to the studs with predictive tech and freezing all capital returns just to buy the biggest ticket item on the board. So I guess the real question is, where does this leave their actual trajectory as we look past this fuel shock and into the back half of the year?
Well, it leaves them basically staring down a very bumpy second quarter. Management is affirming their 2026 outlook, which is, mid-single-digit EPS growth. But Jennifer Hammond was pretty explicit about Q2 being, frankly, a mess. They originally modeled diesel at $2.35 a gallon back in January, and now they're saying it will likely average over $4.
Oh, right, because of that 2-month lag on the fuel surcharge. They just have to swallow that up front.
Exactly. So Q2 margins are definitely taking a hit. But if you look past the immediate fuel shock, the broader picture is just, it is a waiting game. They are keeping capital expenditures pinned at heavy $3.3 billion. They are not buying back stock. They are literally just optimizing the existing network and holding their breath for this April 30th regulatory refiling.
It is really kind of wild when you step back and look at the whole narrative here. You have this old school railroad leaning on hyper advanced predictive AI to squeeze hours out of a train yard. just to afford a monumental empire-building merger.
Yeah. It's the contrast that makes it interesting. They're deploying, futuristic tech just to survive 19th century monopoly politics.
19th century monopoly politics. That is exactly what it is. I mean, Vena essentially told the regulators they have to become a giant just to survive the other giant, Berkshire. It feels like they are betting their entire next decade on Washington saying yes by Q2 of next year.
They are. And until that happens or does not happen, the stock is basically a massive waiting room with, well, extremely efficient trains.
A very efficient, slightly expensive waiting room. I love that. All right. I think that is a perfect place to park the engine for today.
I would expect nothing less.
Thanks for joining us for another earnings teardown. We'll see you all next time.
Take care, everyone.
So if you like having these deep dives just show up in your feed, feel free to follow the podcast. Just as a quick aside, we do use a little AI assistance to help us comb through those massive SEC filings, which honestly just leaves us more time to piece the real story together. If there's a specific ticker you want us to tear apart next, send us a note at earningsunscripted@datamadness.ca or find the X link in the show notes.
See you out there.